welcome back, traders and investors. We have Justin Pulitzer on the line. He's a swing trader. He was born and raised in New York City, attended Stern School of Business, holds a degree in finance and marketing, and has been trading since the late 1990s. Justin, how you doing today?
Good morning. It's good to be back.
All right. Well, you stuck your neck out and you made quite a few calls. I'm not sure if they were all on our show. Some of these are probably going back a little bit farther, but you were pretty bullish. Twitter and Facebook going back to its IPO price. Let's just start with the Twitter and. What is your current outlook for Twitter? You had the good earnings, you had the big rally, and now it's just kind of been a slow fade here. You think that the buyers are just waiting for this to come back in to fill the gap here, or are you going to lean with the Barron's article that thought that Twitter earnings were a joke?
So that was a pretty bold call, right? Twitter at the time was pretty hated, and my call was that it was going to get back to 50, and it did that in the after hours after earnings, and it even pushed up to 52. My thoughts on Twitter now going forward is that you came into what was a very large breakdown area. 50 had been a very strong support for a while in Twitter, and after that gave, it never really looked back. It was just down, down, and down. So it makes a lot of sense to me that it would rally to that point and then have, all the people who had gotten buried at that point, all the overhead supply and inventory would now want to come back and be made whole. So my calls, I had actually CC'd you guys on it because I know that Facebook and Twitter were ones I had mentioned on your show, was actually to be a seller in the after hours at 50 and at 52. And those calls turned out to be quite prescient. As far as Twitter goes now, it never even saw that as highs in regular hours trading. It was only in the after hours. So the hurdle really for Twitter to get the momentum, if it wants to start going higher again, is that it'll have to take out the regular hours trading day high, which was 48. That was the day of the earnings, and for it to really get some, momentum and show that it's cleared the sellers, it's going to have to take out that high of 52.48. My opinion about how to trade Twitter and what I've told people now is that it seems like it could be trying to fill the gap, or at least do a partial fill. It's sort of been it's been coming down, but it's been a bit begrudging. It's not coming down in force. There had been some reference highs just a little bit below us here. I see in the 42, between 42 and 43 area, 42.95 had been a pretty big top, and then you had some more reversal. So you might get into that region, and my call has been to sort of sell puts in the lower 40s at strikes around or below the gap fill.
Okay, and yeah, I'm telling you, I know you're talking about the after hours trading because I did have some weekly calls in there when it was trading like 50, 51, 52. I was in a account where I could not trade in the short in the after hours, and I was just licking my chops there. But do you trade the actual stock? Or do you trade options on?
I usually do trade options, but for Twitter, this was one of those rare instances where I had shares, so I was able to trade in after hours and take my profits.
Yeah, it never did see those levels. So, similar story with Facebook had the blowout
I
earnings. I'm
I
sorry.
do I do think you'll see those levels in Twitter again. I disagree with the article. I think their earnings were fine. Obviously, if the earnings were bad, the stock would have been down on their earnings. The stock did not go down on their earnings; it went up. I think that it was also set up technically that way, with the way that the balance had been as far as long to short, at least in its current condition. It had came into the earnings near the lows. I mean, the stock was maybe $2 off of its lows. So it seemed to me that a very asymmetric risk for a rally higher. I do think the earnings were fine. I think that it's just a matter of supply here. You had run into you would run into sellers where a stock had broken down. That's it. I mean, there's really no revisionist history.
Yeah,
That's just what happened.
pretty simple technical analysis. And same with Facebook here. Had that gap up from the good earnings, and now it's just like you can say, begrudgingly filling the gap here. So, are you looking for this to come down to fill the gap, or are you gonna try and are you looking to let it go
Well, face,
beyond that? Yeah,
well,
Facebook.
well, Facebook, I think actually, it did what it was supposed to. It rallied up. It made a new high, which is what we had discussed the last time I was on. I think it actually kind of did fill the gap here. I'm just looking at it. It's they
Close.
are really close. So my big beef with Facebook, which I didn't like, I don't like to see a stock rally into its earnings, which Facebook did. The day before it had rallied, it had been up a couple of bucks, and then it had that that pop. So the question is now, was that the exhaustion, or is it going to come back and kind of recharge? My thinking is that it may have short term been a peak, but I do like, again, the grinding action. It didn't just slam back down, and I would think that Facebook, if you start getting if you get the gap fill, for me, for the stock to remain healthy, it really has to stay above its 20 and 50-day moving averages. And you're going to see that 20-day MA come into play, soon in the high 70s. It may even be 71 by the time it gets there. And you had a descending trend line, which will probably coincide with a 50-day moving average if you wind up taking back more of that. And for me, the stock, for it to stay healthy, has to remain above 67 to 68 with possible slippage to 66.5. But you don't want to see those levels get taken out.
Hey, Justin, I hear you talking about technical analysis, and I also throwing in fundamental analysis too. What would you say is the percentage split? Are you like right equal? You're following the fundamentals and the earnings of the companies, and also following the technicals. Are you 50-50 split, or are you more leaning one way or the other?
Well, that's a great question. It sort of depends. It depends at any given point of time, because I don't really just use only those two. I have a third component, which is the more macro view, which has to do with the trend of the market, and a lot of it is influenced by money supply. So the market, obviously, we saw a couple of days ago, had a precipitous decline. What started as a liquidation break and became a trend day, and it was probably more than most people were expecting at the time. So I always have to factor that into my model as far as price action. So if you have a declining market, you have to start expecting, shortening up your time frames and looking for, I guess, smaller swings. It's all time frames for me. It's not necessarily, nothing exists in a vacuum. It's sort of all relative at any given point of time. Sometimes the technicals are very important. Like the other day, I had made a call on Twitter to sell puts in PM. That's that Philip Morris stock, and it was when it was right on its 61.8 Fibonacci. So that was one of the calls that was a purely technical call, which was right or right out. Philip Morris had been coming down. They had some disappointing earnings, but that wasn't relevant at that point to the trade, and neither was the underlying market condition. It was just that it was at its 61.8 Fibonacci. So it always depends on what the stock is and what the setup is, which factor weighs more.
Okay, let's just go to Apple here. It's been, I'd say, pretty quiet here. I mean, it's had to run up over earnings. Hasn't been able to get to the all-time high yet. I think what's interesting is this stock is like on a relative strength basis during the recent declines in the market. This thing just has not go down. How do you like trading it post-split?
All right, so Apple is a precarious one. It's a stock that people either love or they hate to love or love to hate. It's just a very, it's number one, right? Everyone wants to have a shot at the king. My opinion about Apple is this: is that I think the stock is destined for higher, but it may have to see lower first. It's at some pretty critical support here. I see 95 as a very important pivot level, and then shortly after that, there are the 50-day moving average. At the time when I had prepared for your show, I was writing down some of my stocks with some key levels, and at the time this was last night, at the time the 50 MA was 93.71, and I could see it having possible room down to 93.39, which is the 61.8 Fibonacci of the recent leg. I think the problem that's weighed on Apple is that it got very close to that 100 level, which is what everyone's been looking for. And it has seemed to me through the price action that there's been some type of an institutional seller that's been weighing on the price, whether that's David Einhorn or maybe Carl Icahn, or maybe it's just some funds lightening up. That's all speculation. But I have noticed that at points the stock has gone negative, has tried to rally, and that you've seen the volume come in on rallies, and then it closes, and that's been what's holding the stock down. Once that clears, I think it's clear for takeoff, so to speak.
Okay, so yeah, institutional selling there. Do you play the stock outright, or do you like to play the options on this?
It depends. If Apple is like in a ramp to make a run, I usually will play with shares or with options. Currently, I'm just short some puts.
Okay, what has got in the price line here? I mean, this thing was just hanging out the $1,200 level, looking just kind of quiet, negative market, market selling off, and then this thing just explodes. Now we're back over the $1,300. We're trading up 20 today. I have no reason why. Looking at the daily charts here, I see almost a perfect double top right here at the $1,307 level. So we're keeping an eye on his resistance. Do you have any thesis for that monster rally here in Priceline over the last, let's see, we were at 1245 on August 1st, and now we're over 1300, and this is in the midst of a negative market.
Yeah, Priceline is sort of a beast into itself. It's not such a liquid stock. It had been a call for mine for a very long time that would actually be the first stock to 1,000, and it definitely worked. It worked out very well. As far as the recent movement, Priceline tends to have these movements ahead of their earnings often. I believe their print is coming up very soon. It's on. You could correct me if I'm wrong, but I think it's on the 11th before the market.
Yeah, let me take a look here. Priceline is due out. Let's see here with earnings. Anyway, go ahead, give your technical take on it. And yep, you're right. Pre-market on the 11th.
So the story I think with Priceline is that Expedia, which is another travel-related stock, it had good earnings. And this has been a trend in Priceline. This happens quite often. Expedia reports if it's good or bad, Priceline likes to go with it. So I think you had a lot of people who may have been short and they got caught. You also had some technical levels that you were playing around with. I mean, if you look at the stock before this, it had that big extension, that $60 that move. It had been sort of meandering in a range, and it really looked like it started getting some juice over that 1244.80. That was sort of the line. It had been testing above, and that day it took it through. And you're now dealing with a technical condition where you have higher lows and now a higher high in a different leg. So the presumption would be that Priceline should go up and test the all-time high up at 1370, almost just below 1379. Whether or not that happens is, of course, now going to be dependent upon earnings. I don't like stocks as much after they've had a run into their prints. So I would, if I was playing Priceline, I'd still probably be leaning long, but I'd be definitely trimming my size up into that report.
Okay, and just to wrap things up here, you talked about your technical analysis input and your fundamental analysis input, but you also said you just kind of threw a macro in there, and I think that was kind of like the money supply.
Just one more thing to
Sure.
fill up. If another chart that's very similar to Priceline is Tesla, and if you're looking for that type of an action, I think you could probably pay Tesla to the long side over Priceline because Tesla's already reported. So that mystery of whether the stock is going to go up or down on earnings is already over. So my thought is that, and I had posted this on Twitter yesterday, was the trade was to do a risk reversal to sell puts to buy a call spread, looking for Tesla to retest that 265. For that theory to stay intact, you want to see it still hold 245. Just as
No,
a heads
okay.
up, if you're looking for that type of action in chart pattern. So sorry, I didn't mean to cut you off.
No, that's okay. No, 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 you're consistent with your theses there, so it's glad to put that in there. But just going back to the overall market here, big decline, a lot of things going on, and geopolitical, big sell off, came out of the abyss yesterday. Nice day, market trying here to get back up to the 1930 level. Scary day yesterday, but the market did recover nicely. So, just overall market thoughts here. Major run, pullback. Was this the dip, the buy? We're going right back up to all-time highs, or do you see more work to be done on the downside?
Okay, so that's a fair and a good question. My thoughts are this: is that you came down. It's all technicals here. You came down to a 100-day moving average, which is a very important one for technicians, and you saw what should be a bounce in a healthy market. This is still a bull market. Despite what people want to say, you're only a few percent off the highs. My thesis is, though, is that if we're talking about the S&P 500, particularly the cash, the SPX, it had had a severe breakout where this one run really started, which is close to around 1900. It was at 1897, 28 to 1900. Usually breakouts tend to be retested in healthy markets. So all of this fear mongering for me is really for naught other than if that level starts failing. It's very normal, very rational that that level be tested. You have a lot of momentum indexes like the stochastic showing deeply oversold now in IWM, which is the Russell 2000 ETF, and you really have to start seeing that those important levels crack before you can start calling a bear market. We very well may be in one. It could start, and I may have missed like the first percentage or so, but I'm always fine with that. I never am looking to sell tops, and I'm never looking to buy the dead lows. I'm just looking to catch the meat of the moves, the big bulk of the move. And for me, what I'll have to see before I'm ready to go fully bearish on the market, and I'm very cautious right now. I happened to be on vacation at the time when this went on, and my account was in very much in cash, which was probably good because it probably sidestepped me some pain. But I like to see the market make a lower high before it makes a new high, comes down with a correction or price action lower, then rallies up to a lower high, and then takes out the low, that pivot swing of where it had reversed. After that, you can start saying you're in a downtrending and a bear market. But that has yet to happen because we haven't had really another leg up yet. So I would be looking to get long around 1900 aggressively, and if it fails, you're right or right out. The key pivot for I know the Russell has been getting a lot of attention also is 1082, about 1082.53-ish. If you start breaking that level, and I think that translates into 107.77-ish in IWM, that would start confirming the thesis of the double top, and I would think that you would have a very severe leg lower after that breaks and is retested.
Okay, what would you say? It's right in or right out? Was that the term that
Yeah,
you?
yeah. You buy the support. You buy it right there, and if you're wrong, you obviously you'll take a loss, but you'll take a small loss. So
Okay.
you're right, or you're right out.
Okay, I like that. I like that. Okay, we've had Justin Pulitzer on, and he is a swing trader, making some fairly long-term calls on the market. We like that because we sometimes get too caught up in the short term. So we'll be looking for that chart pattern in the S&P, and we'll be looking at the other chart patterns that you discussed. And we hope to have you on again soon.
Absolutely, guys. Have a good day.